Sigma, you have 1 minute until you're live. So you could sit at the front. All the groups will be sitting at the front.
Around the world. Harvey dice.
So try to move the mic around. Got the mic here also. Yes, it should work. And there's the globe. 20 seconds. That's the mic. That's the mic. Okay, let's get started. We have rapid fire. We need to keep to the 10-minute schedule. Everybody's got the schedule, right? And there'll be 1 minute setup time. And I just cost you 10 seconds. So we'll go ahead and sit down.
Good morning. We are the Sigma Asset Management team, and this morning we're going to talk about hedge funds, explaining hedge fund performance with risk. We actually thought this would be a really interesting topic because there's a lot of discussion in the media about these great hedge funds that deliver exceptional returns with very little risk. There's a lot of talk about George Soros and Julian Robertson, so we thought it might be a fun topic to research.
Bouncing over the screen.
This is just the agenda for this morning. I'll quickly go through some of the background on the hedge fund industry. Then I'll hand it off to Presho, and he'll go through the methodology of our research and go through the results, and then we'll have a few minutes at the end for question and answer. First of all, the hypothesis. We set out trying to decide whether or not hedge funds really do generate significant excess returns after adjusting for risk, and that was the basis for all of our research. Some of the background on the hedge funds. The easiest thing is to sort of compare them to mutual funds, which most of you are familiar with. There's 4 main characteristics of hedge funds. The first one deals with the trading strategy, and it's more of a dynamic trading strategy versus a static trading strategy. The mutual funds tend to sort of buy and hold stocks. The hedge funds will get in and out of the markets very quickly on a daily basis, intraday, monthly, so they're much more active in the markets. The second main characteristic is the use of leverage. As you'll see later when we talk about different classifications of hedge funds, it's clear that the hedge funds use a lot of shorting and they'll leverage up their positions. And this obviously can affect their returns. The third characteristic of hedge funds is the regulatory environment. This is one of the key aspects of our research, and if you look on our website later for the final report, you'll see that it's very difficult to get clear and accurate information on the hedge funds. Basically, the hedge funds are set up as limited partnerships, and the way that the regulations are set up in the U.S., they're sort of considered a private placement, so they're exempt from most of the notification requirements by the SEC and the CFTC. So as a result, they're very secretive. It's very hard to get accurate results, and that can affect the information that we use. The fourth main characteristic is the compensation of fund managers. There's 2 elements of the compensation. The first is sort of the fixed management fee, which is usually about 1 to 2%. And then the second main characteristic is the so-called incentive fee, which means that the hedge fund managers can make up to 15 to 20% of the profits when the hedge fund does well. So it sort of acts as an option for the hedge fund managers. And the main difference is when the market goes down, the money managers don't necessarily feel the brunt of the downside that their investors do, but they get potential of the upside returns. In terms of the performance of the hedge funds, we looked at the CSFE Tremont Hedge Fund Index, which is sort of the leading benchmark for the industry. And from 1994 to 2000, the average annual return was 13.2% with an annual standard deviation of 10%. And again, it's very difficult to accurately measure their returns because there's certain biases in terms of what funds are included in the data. Other funds, such as like the Soros funds, they may not be included in the data because they don't need to market their hedge funds to raise more capital. So it's very, some of the data can be very misleading. Finally, I'll hand it off to Kresho and he'll go through the methodology.
I'm just gonna stand up and just go quickly through this. Basically, what we tried to focus was on highly volatile periods in the market, and we wanted to see how hedge funds perform during these periods, because part of our hypothesis was that when markets are not very volatile, maybe there is the beta of a hedge fund is around 0, but when they become volatile, we expected that actually betas would increase, and therefore there would be higher correlation and a higher possibility for a hedge fund to explode or really underperform. So what we did, we selected a bunch of hedge funds here. There's just a table of different round hedge funds, and then we selected different benchmarks for each one of them. And we focused on each one of these benchmarks. And what we looked at first, what was the average return, and then we looked at sort of, whenever the benchmark performed negatively or there were negative returns, we looked at that area. And then also when it performed positively, when monthly returns were positive, we looked at that as well. Then we went a step further and said, well, let's look at some more extreme periods. And we kind of took a threshold of having average return and one standard deviation away from it, and then looking at returns during those periods of the benchmark, and then observing what happens to the returns of the hedge fund at the same time. So the results were quite interesting. We analyzed each one of these areas as a sort of a separate function, and then we looked at the lowest 15%. So when markets perform really bad, or when benchmarks created or returned a very negative return, then when they had lower 50% return all the way to the highest 50%. And for each one of these, we calculated the betas. And you can see that when we had very negative returns for the benchmark, actually the hedge fund beta was higher. And then as we progressed and had positive market returns, our betas decreased. And actually some of them even became negative. Now we have some let's say extreme funds here, like this one. This is a dedicated short bias hedge fund, which is a 100% short fund, so it really shouldn't be here. But the rest of them, they show kind of the proof that hedge funds do change their betas depending on market volatility. So just to summarize, majority of hedge funds have betas that are different from 0, and these relationships that we were observing between returns are not really linear. And the most important thing is when we have this spike performance, betas do change. And the bottom line is that the returns that you get with hedge funds that are actually questionable, looking over the last 5 years, that they were in general not so great, you do get them at the expense of volatility. So as the final word from our team, it's volatility or returns. That is the question.
I've got a question. A couple of things. One, you mentioned that they had kind of this option-like payoff for the managers. So you would think that that should induce a certain type of risk-taking, right? So you don't experience the downside, but you actually get the upside. So how do that's different than, let's say, a mutual fund. So how do you think that this affects their behavior?
The money managers behavior?
Yeah, the hedge fund managers.
Definitely, we think it definitely affects their behavior. I mean, in some of the readings we did, first they're trying to go for the Hail Mary, they're trying to get the biggest returns. One thing that sort of mitigates that is the fact that the hedge fund managers normally invest a large percentage of their own money into the actual hedge funds. So that may tend to downplay the risks they're going to take, but it does seem that they would take much bigger risks, and that's that's another reason why the returns aren't going well.
There might be another thing. When a hedge fund goes under, then the fund manager he's not disappearing from the earth. He thinks about raising another fund. Of course, it's another kind of factor that restricts him from taking unwise risk. So that's another factor that keeps the fund manager in a certain range.
Okay, a second question. You mentioned when you showed the average returns of like 13.2% and volatility of 10%. The market volatility around that time was about 15, let's say, just if you invested in the S&P 500. So it's lower volatility, higher return. And then you mentioned, well, there's a lot of data problems here, that some funds are not listed with the vendor of that index because they don't need to market. So wouldn't that imply that the returns could actually be higher if these closed funds were actually in there?
I mean, I think that's one element of it, but we think that actually the bigger bias is on the other side in terms of like the survivorship bias. The funds, the database vendors are really only including the information on the hedge funds that are surviving. So that will tend to inflate the numbers a little bit as well. And also the hedge funds that do give their information to the database vendors, they only do so voluntarily. So they're only going to really give it to them if their returns are pretty good to try and market it. So a lot of the hedge funds that aren't doing well aren't going to give their data to the database vendors. So we think that there is some element of it dampening the return. We think basically there's more bias to that would reduce the returns.
Good. Okay. That's great. We have like 25 seconds for a question. Any other short question? Okay, thank you. BTC.
Good morning. We are BTC, Sean Flynn, Chris Ray, Ruta Coffin, Jay Weber, and myself, Holly Dice. Our study takes a look at currency unification, and specifically we wanted to look at what happens with foreign currency volatility and equity returns. And we specifically looked at the European Union and the effects of the euro. So we'll take you through our hypothesis, we'll define the Eurozone, we'll explain our methodology, we'll talk through our analysis, and then we'll provide our conclusion, and then also talk about some things that we could have done for further analysis to enhance our results. Our hypothesis is basically, it was developed with the notion that a movement towards a unified currency would, in fact, lead to an increase in integration between all the countries that are in a specific region, and then also move to eliminate exchange rate risk. So there's a three-part hypothesis. It's the unified currency within a region will reduce this currency volatility between the countries, which would decrease equity market volatility, which hence should decrease equity market returns. Just to define what the Eurozone is, for those of you that aren't familiar, the European Union is a little bit separate from the Eurozone. There are 15 countries in total in the European Union, but only 12 of those are participating in the Eurozone. As you can see, Austria, Belgium, Finland, France, Germany, Greece, Ireland, Italy, Luxembourg, Netherlands, Portugal, and Spain. Our methodology began with obtaining daily currency exchange rates and then calculating an average monthly standard deviation. We also pulled monthly equity index returns from MSCI, and those are in the local currency of each individual country. We examined the equity return correlations, assuming in conjunction with our hypothesis that these correlations would revert to 1 over time. We also looked at foreign exchange correlations, assuming that the standard deviations would revert to 0 over time, and we regressed the exchange rate deviations with against the local equity returns to see what kind of forecasting we could come up with and what kind of relationship might exist. So again, with our regressions, we performed, we didn't really get very high. Our squareds, they're pretty low, as you'll see in a couple of slides. We performed a raw direction count, again, to see the values of these regressions. And our raw direction count actually turned out to be pretty robust. And we looked at this raw direction count relative to 2 specific metrics, the euro-dollar interest rate and the world equity returns. We also performed some forecasting, an out-of-sample forecast from 1999 to 2001 samples, and then we calculated conditional volatility using ARCH. This graph, you can't see the title, but it's the monthly average standard deviation that's based on the percentage change of the German mark versus other European country forward exchange rates. And basically, this is a pretty good graph. Actually, it shows that the standard deviation converges at about the year 1999, 2000, which enhances our hypothesis. And we certainly observed a decrease in volatility here. This is a chart that shows our equity returns for each country relative to Italy. And we would anticipate over these 3 specific time periods that we looked at, from 1973 to 92, 1993 to 1998, and then 1999 to 2001, we would anticipate that those returns would increase. I'm sorry, that the return correlations would increase, again, converging to 1 over time. And you can kind of see that for 2 of the countries, for France and Germany, which are, okay, yeah, those 2, it pretty much proves our hypothesis, although we've got some outliers here with some other countries that even have negative correlations.
So these are correlations, correct?
These are equity correlations.
Local market returns.
That's right.
And we see that they increase very substantially.
And perhaps the reason why for Germany and for France, there's such a large portion, they make up such a large piece of the Eurozone as a whole, that perhaps their contribution is more visible than the other countries. Our regressions, again, our R-squares are pretty low. The best one is 1% Belgium. However, our direction count, consistently, we've achieved better than 50%, which is better than, I guess, not being able to forecast. And in conclusion, we have proved our hypothesis well. We've observed that increase in correlation between Eurozone equity returns does in fact exist. We've also observed a convergence in the currency volatilities among the countries within the Eurozone, but we were unable to prove a robust relationship between the equity returns and the volatility. For further analysis, our equity returns are affected by a number of factors. It's not solely the currency fluctuations. So perhaps we want to integrate a couple more variables in our analysis, including market cap, macroeconomic factors, dividend yields. Also, the euro introduction was not the distinct radical event that occurred that the European Union has actually been integrated for years, not specifically because of the euro, but just because of the cross-border transactions that have taken place. And so that might decrease volatility in itself. And also for further analysis, we might want to just identify other regions in which we can perform this sort of analysis around the world.
Yeah, couple of questions. You looked at local currency equity returns. Is there a logic to looking at US dollar equity returns and performing a similar analysis. So why did you choose local equity returns?
Well, there are two distinct features. Obviously, if you looked at the US returns, you would have some currency volatility that takes place. Right, that volatility is decreased because the euro has got is larger relative to, say, the Austrian shilling.
Yes.
Whereas if you look at inter-Europe on a local basis, we can provide, we can run the analysis to say Portugal and Belgium and see the correlation there, as we've actually observed. It's in the smaller markets that money actually left some of the markets, and the volatility increased in some of those equity markets. And our thought was the money was leaving markets because there wasn't that currency risk, and the euro encouraged kind of cross-border investing, like you say that, but we wanted to isolate the FX volatility portion of it, and by incorporating the dollar, you still had some FX volatility. And as our regression analysis showed, foreign exchange is just a tiny portion of total risk when investing abroad. That answer your question?
Yeah, so I guess the point is that local currency returns can still be impacted by currency volatility, right? Because you do your business in the US, you're going to be impacted by what's happening around the world. So I think it would be interesting also to look at a common base, whether US or whatever, in the analysis. The other thing is that the correlations increase, the equity local market correlations increase, and that's real clear here. And I guess one interesting thing would be to look at the betas versus kind of a world benchmark. And again, you would have to put it in a common currency. Are these betas impacted by the decrease in currency volatility? So even though you don't get a strong relationship when you looked at your currency volatility variable, you kind of know the volatility's decreased, and you know that the correlations have increased. So there's got to be some relationship going on there. Maybe your test is just not powerful enough to pick it out.
I think the interesting thing with regards to those three periods is that it was increasing for the larger countries. And the smaller countries like Austria or Portugal, it was actually going down. So I think at that time you saw a lot of people moving money, say from the Portugal markets to Germany or France, where they no longer had that currency risk anymore. And we're basically trying to get diversified portfolios in Europe. Right. And Germans weren't necessarily, national Germans weren't, or German fund managers weren't taking and buying Portuguese equities at that time. And maybe that'll happen in the next few years. I mean, there hasn't been that much of a time period down.
Right, that's interesting. And just the last thing, a remark that we know that other countries will enter, and there's timetables and things like that. So there are a lot of real implications for asset management. Given what you can learn from the history, like this analysis, that can be kind of like used in terms of how to manage your asset allocation as these new countries enter.
It would have been also interesting to look at Greece as they came into the euro,
Yeah.
and what's happening just in that moment.
Absolutely. Okay, that's great. And first year's asset management.
Got it. Did you ever speak to hold the microphone? What? That's when it puts you out.
Okay, good morning. We are the first year asset management team, and today we are going to talk to you about the effect that the ADR listing has on underlying equity behavior. ADRs are American Depository Receipts, which is basically foreign equities which are traded in the US, but actually they're traded through a US bank, but the underlying stock is still the local stock. And the idea that we had was that maybe when the foreign equity is listed in the US, something is going to change in terms of returns, in terms of behavior, so on returns, on volatility, on correlation to the local market versus the US. We're basically trying to answer these two questions. Does foreign equity behavior change after being listed as an ADR? And does sensitivity to local market or US risk factor change after the ADR listing? That's basically resuming what I just said. The way we did this is to select 17 stocks of 3 major industries. These are all large cap stocks, and the reason why we've chosen this is that basically for data availability, and obviously further analysis would be to go to emerging market stocks or even small cap stocks. And our procedure, we went through 3 steps. The first thing that we did was to verify whether there was an effect in the exact period of the listing. So we basically defined a dummy variable, which is 1 for the ADR listing month and 0 otherwise. And we regressed the returns on the underlying stock on the local index, which we orthogonized in order to take read of the covariance to the US, to the US index, and to the change in the foreign exchange rate. So we ran 2 sets of regression, one without the dummy and one with the dummy, to see whether the explanatory power of the regression changed. And our results were not that clear, actually. We do see a slight increase in all the R-squares for all the 17 stocks on regressing with the dummy, but still there is not a clear direction on the coefficient. I mean, sometimes the coefficient is positive, sometimes it's negative. Most of the coefficients were very small, so it seems like there is an effect, but it's unclear whether this effect is very big or not. The second step was regressing the returns on the underlying stock on the local index, again orthogonized, on the US index and on the change of the foreign exchange rate. But this time, we basically took 16 months before the ADR listing and 60 months after the ADR listing. And we treated these 2 time series as 2 different time series. So we actually regressed it before and after the listing as an ADR to see if something changes in the coefficients now. This graph shows you that in 14 out of 17 stocks, we had a decrease in the coefficient to the local market. So the correlation to the local market seems to decrease. We didn't have clear data, clear effects on the US index and the foreign and the forex coefficients, but we thought that this might be kind of interesting. I know that the sample is very low. R-square were not impressive, but still 14 out of 17 stocks had this decrease effect. So it seems like listing the ADR in the US kind of makes the stock less correlated to its own market. The final step was we ran a cross-sectional regression on the average returns. Basically, we took the betas that we estimated in step 2, and we ran 2 regressions again in the period before the listing and after the listing to see whether the relation between the betas and the average return changed. And we have few graphs on this. It seems like there is not a huge impact. So we have the betas. This is the local index beta. So the betas and the average return is on the y-axis. And okay, low R-square, but that line fit seems not to have changed very much. The next one is on the US, and here actually there was almost no correlation at all. And in the last one, which is versus the forex, again we have a slight change, but probably our data are not enough to have a very, very certain conclusion. We also looked at the volatility and the volume traded on those stocks. And for what concerns the volatility, we did 2 things basically. The first one was taking a 12-month rolling standard deviation of the returns of the underlying stock and plot them just to see whether before or after the ADR listing there was an impact, a visible impact. We didn't get any result out of this trial. And actually also comparing just the standard deviation of the time series before and after, we have 11 out of 17 cases, which is basically saying that in half situation volatility increased, in half decreased. So not a clear conclusion out of this. basically same thing for volume traded, but here the reason why we cannot draw a conclusion is different, because actually it seems like there is an increase in the volume, but some of the, I would say most of the listings for the stock that we picked happened in a period that was right before a time period where the volume of the overall volume of the market increased. So we noticed an increase in the traded volume, but actually we were unable to say whether this increase was related to the ADR listing or to a more broad market behavior. So our conclusion are this. Our data do not indicate a clear effect on the return of the underlying stock from listing as an ADR in the US, but our analysis suggests that the sensitivity of returns to the local index increases after the ADR listing date. So further analysis would be to have a larger sample of stocks, to go to emerging markets where we actually would expect a higher effect, since if we take a stock in Germany, we don't expect the listing in the US to change completely its behavior, while if we take a stock coming from an emerging market, we might see a bigger effect, since now the stock is more liquidly traded on the US market.
A couple of questions. Well, there's one important remark here that you had no chance of doing because it's incredibly difficult. That there's a difference between the listing effect and the announcement effect. So if you actually, they just don't pop onto the U.S. exchange. Like there's a process that you actually go through. And people kind of know about this in advance. So the most powerful tests would be to actually go for each one of these and figure out when they made the announcement that we're going to do the ADR, and then to see if there's an effect on the returns. And indeed, what you find that there's no pretty significant return effect is maybe consistent with the information being incorporated into the market. So that's kind of like, if you'd found something different, I would have been like surprised about that. The other stuff, I had a question in terms of how you did the volatility before and after. Couldn't that be affected by what's going on in the market in terms of volatility?
Yes, of course, you could. Actually what we were looking at was a dramatic change, something like that pops up to our eyes, and we didn't get that. So basically, yes, we knew that the volatility is very much affected by what the market is. But if we, for example, actually saw a dramatic change, then something was going on there.
Right. And there's ways to do that. So we think of adjusting returns for what's happening in the benchmark. So we run a regression and estimate a beta and look at the residual patterns. Well, there's also a way to do that for volatility. It's called a factor volatility model, where you can think of just allowing for general movements in market volatility and looking at what's not explained by the market. And the same thing with volume. So that's feasible. It's difficult. The factor volatility model is, again, something not feasible right now with a Garch, multivariate Garch. But that's possible. So, but the most interesting finding is what happens with the local correlations.
We had expected that as the local market correlations decreased, so the U.S. market correlations would also increase, but we didn't really find that across the board. It only happened in about half the cases. So we got half of our expectations.
Yeah, half. And as you say, with a larger sample, with smaller firms, I'm sure it would be much different. Indeed, dramatically different, because you're operating with emerging markets, especially with a very small correlation with the U.S. to start. And then once you ADR, correlation will jump on. That's good. Okay, great. Thank you. Fat-tailed dragon asset management.
At the Fat Hill Drug and Asset Management, our managers are Atsushi from Japan, Jinsu from South Korea, Jiang from Indonesia, Liton from Taiwan, and myself from China. The project we did is quantitative stock selection by score screening. We looked into a couple of attributes and decided to try both accounting attributes and technical attributes. And for accounting attributes, we chose to use trend in return on invested capital, which is defined by return on invested capital in year T minus return on invested capital in year T minus 1. And for technical attribute, we chose to use price momentum, which is simply the percentage change in stock price. And we looked at the time period from 1982 to 1998. And our data sample is S&P 500. And we used the S&P 500 list in 1998 as benchmark and took out the stocks that are not included in the list in the previous years. And for investment cycle, we chose to rebalance annually on each March 31st. As the first step, we look at the two attributes separately. For example, in the case of return on invested capital, we buy the top 50 and sell the bottom 50. And we got an average annual spread return of 4.28%. And this graph shows the average return over the years throughout the 16-year period. And in the case of price momentum, we got an average return of 8.88%. And besides the volatility, we also calculated the correlation between the two sets of spread return. And we found that if we have 79% in price momentum and 21% in return on invested capital, our return is maximized with a reasonable level of risk. So later, we will use 79 and 21 as score to assign to the two attributes. So this is the first step. In our second step, we developed 4 different approaches to combine the stock selection power of the two attributes. And among the 4 approaches, the first 3 are univariate, and the last one is bivariate. And the first approach is, we call it univariate top-bottom 50. And in this approach, we assign 79 to price momentum. We assign 79 and minus 79 to the top and bottom 50 stock, top and bottom 50 price momentum stocks, and then assign 21 and minus 21 to the top and bottom 50 ROIC stock. We then add the 2 scores up, sort, and buy the top 50 and sell the bottom 50. And this approach gave us an average return of 10.85%. And our model actually allows the 2 scores assigned to 2 attributes to change. But we found that the 79-21 combination and a similar proportion work best. And in our second approach, it's similar to the first one, but this time we only buy stocks that receive a positive score from both attributes, and only sell stocks that receive negative scores from both attributes. And our model also allows the number of stocks that actually receive score to change. And we experimented with that, and we found that when we assign a score to the top and bottom 150 stocks in price momentum, and top and bottom 5 stocks in ROIC, we got the best result, which is 12.77%. And the third one is quintile. We simply divide the stocks into 5 tiers and assign scores that are proportional to the tier numbers to the stocks in each tier. Then add the 2 scores up, sort, and buy the top 50 and sell the bottom 50. And this time we got an average return of 10.66%. And the last one is bivariate. And in this approach, we simply keep the top and the bottom 120 after first start, then keep the top 50 and the bottom 50 after the second start. And our average return is 9.78%. So besides the average annual spread return, we also calculated the average excess return yielded by the 4 approaches and the volatility of the excess. So you can see that double score strategy seems to perform the best. And although its volatility is also higher. And this graph shows the excess return of the 4 approaches over the years throughout the 16-year period. So by working on this project, we found that combining 2 attributes obviously works much better than using just 1 attribute. So we believe that if we included more than 2 attributes, we will further improve our bottom lines. And we also found that the 4 approaches have very similar results and patterns, as you can see in the previous graph. And the pattern is somewhat related with the pattern in the general movement of the market. But since our spread portfolio is risk neutral in most cases, so we believe that our returns are reasonable after adjusting for risk.
Okay, a couple of questions. How many stocks in the universe that you're sorting?
In the bivariate?
In general, how many stocks are you working with?
We start with the S&P 500 as in 2000 because that is what we can get.
Okay.
And back to 1982, it left only around 250.
Okay.
And that is, we know that is there is a problem for database.
Yeah, okay, so just to be clear here, ideally we want to choose the 500 in 1983 and then move forward with those. But given the data limitations, this is what you could do. Okay, got it. And the second question is, I didn't understand the excess return. What in excess of what?
RM.
Oh, okay. So
Yeah,
just a
risk-free.
treasury bill
Yeah,
return.
risk-free.
Okay, got it. And I guess the other thing is that in looking at just the 500, you limit yourself in terms of the possibility. There's 2 things that are limiting your analysis. The first thing is that you're concentrating on these big cap stocks. And the second thing is that, I guess in my research I found that there's a lot of value in looking at these expectational attributes. And what you're looking at is a technical attribute, momentum, which is important, and then ROIC, which is more accounting based. Right? So it seems like there's a lot of upside. Did you calculate the betas of these portfolios?
Yes, we did. The finding is quintile, that is a scoring method. It works best. That has the highest alpha and lowest beta. That's good news. But bad news is that because of the year database, the beta is quite high. It's between 0.4 and 0.7. And alpha is between negative 0.8 and negative 8% to negative 2%. So that means that based on the equal base of the year database, it shows quintile is most promising. So we conclude that if we include more attributes, that means we definitely need the scoring method that will give us more promising results.
Actually, we had some difficulty in blending data because we chose to rebalance on the end. We chose to rebalance on each March 31st instead of end of December. So we had to collect annual return for each stock starting on March 31st. So we had some difficulty there and had lots of invalid data. And we believe that those invalid data has negatively impacted our alpha and betas.
Got it. Okay, well that's a lot of work. There's a question?
I noticed in the results data that there's pretty mediocre performance for the first 75% or so of the time period, and then it really pops at the end. So you'd have to be pretty patient to get the returns that at the end, right?
I guess so in this case, because as I said, the movement, the patterns yielded by the 4 approaches is just similar to the general movement of the market. When we graph the movement of the market, we also see that big spike toward the end.
Okay. Also, the validity of what they're doing is you have the most confidence at the end of the sample because they're picking up the S&P 500 at the end. So given that it works well at the end, that's good, I think. And also, the other thing is that when you're looking at strategy, you hope it works near the end, not the reverse, where it works really well in 1983, but decreases through time. Okay, that's great. Okay, just BSD.
Okay, we are at BSD. We're predicting the Dow going up the income statement. The agenda today, we'll start out with the hypothesis, talk to you a little bit about how we collected our data, how we organized our data, then we'll show you some of our results and go into conclusions. Our hypothesis is the further you go up the income statement, the better the variables will be to predict the returns for the Dow. Our rationale behind this was that dividends could sometimes be at the manager's discretion. They can choose when to issue them or how much, and a number like EBITDA is a lot harder for them to manipulate. So for data collection, we collected data on 30 companies that make up the Dow Jones Industrial Average. We got quarterly data from 1979 through 1999. And if you're not aware of how the composite is made up, has 30 companies and it's reallocated every once in a while. So there were 6 different times the companies that were actually in the Dow were changed. So we had to change our data all at these same periods. The income statement data was evaluated on a per share basis for EBITDA yield, dividend yield, earnings yield. We had to also calculate our divisor for our whole index to be able to actually reproduce this index. Part of our challenge was we had these 30 companies over time, and we had what the Dow actually was, but could we match that with our data that we had? So we had a lot of problems getting all our data exactly right, being able to reproduce this index, reproducing our divisor so we can calculate actually these different variables for the whole index as a whole. So the first thing is we actually built the model of our Dow Jones. We actually came pretty close over time to show that our actual Dow Jones index matched what the actual results were. So we're fairly confident that we understood our data and we were able to use our data going forward, predicting our results.
Okay, so that last graph was the divisor that we were using to calculate our index. We decided to use 3 different measurements to measure how closely the 3 EBITDA, dividend yields, and earnings could be used. And one was a scatter plot, similar to the S&P dividend yield 500 plot that was shown earlier in the term. One was multiple regression, where we looked at the p-values of the 3 different variables. And then one was an arch methodology, where we also had validation period. So here's what the scatter plots look like. You'll notice that the earnings and the EBITDA, we lagged them by 3 years. We wanted to see could they predict Dow Jones returns in 3 years ahead. And there were a couple outliers on the earnings and the EBITDA, so it kind of skews a little bit of our model. But in general, we noted that the current dividend yields, the EBITDA yields, and the earnings yields are generally within the range of the scatter plot. So It's not we don't have the same issue that the S&P 500 dividend yield had, where it's outside kind of the scope of the past performance. So in terms of relevancy, it looks like the three variables that we built have relevancy. Next slide. Okay, here's the p-values that we got, and we noticed that, interestingly, the dividend model and EBITDA model have very similar p-values, just our squares, but the earnings model appears to not have a significant p-value. So we thought that was really interesting. We thought that the dividend model would have less predictive power than the EBITDA model, just because dividends have more discretion behind them. And the model that we used for all three also included a couple. We included a couple other macro variables as well. And the only thing that was different between the three models was whether we used dividend yield, earnings yield, or EBITDA yield. So these are the coefficients that we came up with in our model. And all of those seem pretty intuitive, except for the T-bond 5-year, which we noticed was positive. And we're thinking that because these are the Dow 30 with high cap stocks, if in case there's a flight to quality in terms of a recession, people are going to stick their money in the Dow 30 big cap stocks. So that makes sense. Okay, so here's our models. We calculated 3 different models, and we also have the observed Dow Jones Industrial Average, and this is the in-sample results. So you can see we kind of bounce around quite a bit, but they all three of them are very similar in terms of tracking each other. This is our out-of-sample results. We had a validation period, and we also have a forecast. And from this, it looks like our models have some slight predictive power, but I mean, you can see we're predicting a really bullish market right now, and that clearly is not the case. But the important thing to take note here, though, is that the 3 variables together, dividend yield, earning yields, and EBITDA yields, there's really not a whole lot of difference there. So really looking at the differences between the 3 is kind of like splitting hairs in many instances. So what are our conclusions? We noticed from the scatter plots, the p-values, and from looking at the ARCH modeling, that EBITDA yield appears to be as good a predictor as the dividend yield, which is counter to what we thought would happen. We thought that EBITDA would be better than earnings would be better than dividends. And the confidence interval on predictions for earnings yield is less than 90%. We're thinking that it might be because since earnings is such a highly looked at number, that management's focus a lot on massaging the earnings figure. But dividends, because it's a Dow 30 company, they're a bit more stable, and also EBITDA is harder to manage, so that explains why earnings generally performs less well than the other 2. And that's it.
A couple of questions. First, there's one common component in all of these measures, and that is that you divide by price.
Right.
So some people have said, well, why don't you just look at 1 divided by price and see how that does. Maybe there's no information in the dividend or the earnings or EBITDA. Just look at 1 divided by price. So that's something that you could potentially do. And I guess a question is, they look similar. What? And maybe I missed it, but did you do like a correlation analysis of the different measures?
No, we didn't do a correlation analysis of the 3, because really the gist of our project was to test which of the 3 was best, not necessarily to look at the overall accuracy of all 3 or the 3 put together. So we didn't look at the correlation between the 3, but after looking at our results, it seemed like their models highly correlated. They all had peaks at similar times, they all had dips at similar times. So obviously there's some commonality going on.
Yeah, explain why the dividend yield is delivering such a high forecast for like 17, 18,000 for the Dow for next 3 years.
Yeah, we're thinking that probably the 3 variables are, it's a lag 3-year period. Yes. We're thinking the 3 variables are picking up data from back in 97, 96, 98. And so the model isn't anticipating any sort of market pullback because it's not related to these variables. It's all backwards looking. So we think that's a flaw in actually looking at those 3 measurements just in general.
We also use ARCH analysis in this, and we saw our coefficients for error propagation. You're basically trying to predict errors or residuals from the previous one. The coefficients were positive, so you have errors getting, residual terms getting bigger and bigger, farther out you go into the out of the sample period. So that's why there is no adjustment for error to ever come back down below 0 using sigma square. That's always possible.
That's interesting. There's a question? Right?
I'm curious if you have the 3-year lag, how you incorporate that in with changes in the composition of the Dow.
Yeah, what we did is, that was actually part of our data organizing and collection. We assumed that the Dow as a whole, the 3-year lag period it was okay to look at the Dow as a whole, even though the composite of the Dow would change, because the differences were only slight. That was an assumption that we made. If we wanted to go individually to each stocks and look at composition changes and how much they affect, we could do that, but given our time constraints and data limitations, we decided to go with this method.
And also, historical data on individual weights on those stocks is not available, at least not readily available. It's only the most current stock weights, within the composite is available. So we would have to run 30 simultaneous operations for a 20-year period, try to get back, from present to what the weights were at any particular quarter.
Yeah, I guess I believe in the original hypothesis that there is information going up the balance sheet. And just a question of constructing the most powerful test. Indeed, one thing you could have done is to, like the previous group, orthogonalize the EBITDA yield with respect to the dividend yield. To take a look at the unique information in the EBITDA yield that's not accounted for by dividends. And is that adding extra information to the prediction? So there's lots of possibilities here. And again, understandably focusing on the Dow 30 for data reasons. Once we go beyond that, we might be able to find even additional information. Okay, that's great. Thank you. Okay, we will take our break now for 15 minutes, and we are starting exactly at 11:40 with GSM.
Is it really?
Yeah. But some people that can go back to that file. Okay, let's get started with GSM.
Okay, hi, we're Global Strategic Management, and at my far right is Luisa Rubino, Mary Murphy, Steve Smiggy, and myself, Gigi Whittam. Our project was on predicting fixed income credit spread movements. Okay, brief summary. We tried to predict the direction and magnitude of credit spread movements for 3 types of credit spreads. First, the 10-year U.S. swap spread, then the U.S. corporate AAA 7 to 10-year maturity spread with the 10-year Treasury bond, and lastly, the U.S. corporate BBB 7 to 10-year spread. The prediction was most successful for the spread between the AAA and the 10-year Treasury bond. And we incorporated this prediction model into a very simplistic trading strategy, and we found that it produced an annualized alpha of 100 basis points over our benchmark. And we feel the predictive power in this model can be used to test other trading strategies. Now, some of you might be wondering why credit spreads. Everyone seems to be focused on equities, and we've heard a lot about the equity markets, but we think that the fixed income markets, first of all, are substantially larger than the equity markets and are very important. Recently, there's an increase in the significance of corporate debt in fixed income portfolio management because of two trends. First, the decrease in the supply of treasury bonds as our government, the US government, is paying down the deficit. We need to look at other asset classes in fixed income. And in Europe, the European Monetary Union has resulted in a reduction in the number of fixed income asset classes in Europe. And of course, credit risk is always relevant for fixed income investors. The next slide shows a picture of historical trends in these spreads. The first slide up top has corporate spreads, and the other chart has swap spreads, and it's just showing the relative movements over the last 10 years. A little bit about our methodology. We reviewed existing research on predicting fixed income yields, and we decided to focus on financial variables rather than economic variables because we felt that financial variables were more forward-looking. Our in-sample data was from January 1990 to December 1999, and our out-of-sample data was from January 2000 to December 2000. We looked at a variety of variables, including the S&P 500 PE, the change of the S&P 500 PE. We looked at some volatility measures, including the VIX, and then also the implied volatility in 30-year T-bond future options. We looked at the 10-year on-off spread. That's basically a liquidity measure. It's the difference in premium between the most recently issued 10-year Treasury bond and the previously issued Treasury bond. We also looked at the lag of the yield in the 10-year T-bond. We looked at the spread between the BBB and the AAA. And we looked at the term structure. And last but not least, we also looked at the lag of each credit spread itself, the change in the credit spread, and then the level of each credit spread. And from these variables, we came up with these three models. Briefly, I'm just going to talk about which variables were important with each model. For the AAA, the lag of the spread itself was an important variable. There's a negative coefficient as we expect it to be mean reverting, so that was in line with our expectations. The swap spread was also significant, and the change in the S&P 500 PE ratio. We expected that to have a negative coefficient because we see PE as a proxy of volatility. The change in the BBB spread, we had the lag change of the AAA spread as an important variable, the change in the swap spread, the change in the 10-year T-bond. We expect the BBB spread to increase with increase in interest rates, so that was in line. The PE, the S&P 500 PE change again, and also the spread between the BBB and the AAA. For the swap spread, we have the S&P 500 PE level. The swap spread itself lagged, and the change in the S&P PE and the change in the BBB spread lagged. All of these variables in these models had significant T ratios. And continuing on to some more statistics, I'm not going to go into all these numbers, but I just wanted to point out the top line, you have the adjusted R squared. As you can see, our AAA and BBB models were the best. We had an R squared of 32.7 for our AAA credit spread, and the BBB was 29.1%, and our swap spread was 6.5. Secondly, I'd like to point out the out-of-sample directional hit, which is the bottom line on this slide. And as you can see, our out-of-sample directional hit is pretty close to our in-sample directional hits. And for the BBB, basically 2 out of 3 times, we're correct in predicting the direction of credit spread movements. So what does this all mean? We want to make some money off of this, right? So we tried to set up a very simple trading strategy, basically using our yields to calculate theoretical prices for these bonds. And so when we expected the credit spread to widen, we would take a short position in the BBB corporate bonds and a long position in the Treasury bond. Basically, we'd be long the spread, and vice versa. When we expected the credit spread to tighten, as shown up here, we would be long in the BBB and then short an equal amount in the 10-year Treasury to try and take advantage of our predictions. We compared these positions with the benchmark of a 30-day Eurodollar deposit, and what we came up with was basically the bottom right yellow highlighted square talks about our annualized return over the benchmark, which is about 100 basis points. It seems small when you're thinking about equity returns, 1%, but in fixed income, 100 basis points can be significant. So we did obtain a positive alpha, so that was great. And next, in our conclusions, basically credit spread movements are predictable. We came up with several models to show that, both the AAA and the BBB. And previous research has indicated that these credit spread movements are valuable information to predict the business cycle. Basically, when credit spreads widen, it's recessionary in nature. And we also feel that future research could test various trading strategies that capitalize on this predictive power. For instance, when credit spreads widen, you could buy cyclical non-cyclical stocks or vice versa. And we feel there's a lot of use for this model. And now we'll open it up to questions and answers.
It's mainly me, given our time constraints. I guess so. Just I've seen this project as it has been progressing. One thing that's really important is that the trading strategy is calculated not off the actual prices of the underlying bond that the yield was taken, because we had the yields on certain bonds but not the underlying prices. So there's a caveat here, and actually in implementing the trading strategy, what you always want to do is to duration match. Okay, so in the long short, right here, the maturity of these bonds are approximately the same, but you need to be careful on the duration. Okay, and I said to this group that I always had a question on my 350 exam about, you had this model that predicted that the yield curve would steepen. Okay, so very reliably you knew that it was going to steepen. And then it asked, what position would you take in the T-bond futures and the T-bill futures to capitalize upon that? Okay, and you have to be very careful. It's not just long one contract, short another contract, because the interest rate sensitivity of the T-bond is like 32 times what it is for the T-bill. So you have to duration match in order to profit on a spread strategy like this. So I guess a question I had for you, we saw it was 100 basis points, and I agree with you. In fixed income, that's a decent, actually a good spread. What about the volatility of that? Did you calculate the volatility of your portfolio return? Maybe it was there, I didn't see it.
We didn't on this last run. On the first run we did. I don't remember if you remember.
So was it low or?
It was very low.
Okay, so you get 100 basis points. So what could you do to turn that into 300 basis points?
Well, instead of going 1 to 1, which is what we did, go 10 to 1.
3 to 1, yeah. Or three by 3 actually, right? So go 3 long, 3 short, and that would, so it's going to increase your volatility. It's also going to increase your return. So when they talk about a leveraged hedge fund kind of return, that's what you're doing. Because for the hedge fund, if you're grabbing 20% of the upside, 20% of 100 basis points maybe is not what you want. So you lever up to a higher level of volatility and actually do that. So, okay, any other questions?
You mentioned at the end about how you can apply this to buying like non-cyclical stocks or cyclical stocks. Can you explain that a little bit more?
Well, basically, previous research we had seen about fixed income credit spreads had talked about, let's see, it was a BAA being a very good predictor of the business cycle. So if you know, or if you use that as a proxy for when you think a recession's coming on, you can buy the appropriate shift out of a certain asset class or certain out of cyclicals into non-cyclicals. That's just an idea we thought for first.
So do the spreads widen?
Yeah, when the spreads widen, it's recessionary in nature. It's indicative of a oncoming
And that's because it's
downturn.
like a default spread, or is it just?
Yeah, credit spreads are basically as the spread widens, it's indicative of a higher chance of default.
Okay, just to emphasize this, that in our models for predicting equity returns, we're usually just using the lag BAA, AAA spread. And what GSM is saying is, well, we can actually predict that spread with 29% R squared. So that might have some extra ability to actually improve your equity forecast. So instead of using just the lag value of the spread, why don't you use the predicted value of the spread and see how that works? So I think that's a cool idea. Okay, great. Thank you. PDF, I think. Is that correct? Yes. How does it, just this button here, you got to point it right there.
Good morning. We are PDF, Yuri, Terrence, Yukping, and myself, Jonathan. We have one member, Pierre, who unfortunately is unable to join us today. Our project investigated the use of momentum in trading across industry sectors. And what we'd like to go through today is our objectives in this project, a little bit about our implementation and methodology, discuss our results, and then talk about some next steps that we proposed. Essentially, our idea was to develop and test a momentum-based trading strategy across industry sectors. There's a lot of academic literature about trading momentum across individual equities, individual stocks, and we wanted to see whether this approach worked on a momentum basis across sectors. And the implications are really twofold if you can do it. First of all, the trading strategy in and of itself can be implemented. And second, there are a lot of equity portfolio managers who need to make top-down decisions about how much weighting to put in each sector going forward. And if we have some ability here, this could be a helpful model for those people. Being such a global group, you would think that we might have picked some global indices to work with, but we actually picked the S&P 500 just due to data availability, but this could certainly be extended to other indices. Essentially what we did was we broke the S&P, or the S&P has been broken into 130 industry sectors. We looked at the monthly returns from January 83 to March 2000, and we sorted according to return. So we picked a going backward period that varied from 1 month to 1 year, and we got the returns for all 130 sectors and sorted from high-low. And we formed buy and sell portfolios based on varying fractals, varying percentages. And we took new positions every month in these strategies. We bought the top performers. We sold the bottom.
Point at the overhead. Right there.
There we go. Okay. And essentially, this was a no-cash investment strategy. We were long, equal weight short, and we didn't have the betas for every sector through every time period that we picked. So we're benchmarking against the zero return, assuming market neutrality here. Although there's certainly some debate about whether this is truly a market neutral portfolio. So our returns, our findings are that we did have some predictive power here. We actually were able to find portfolios that worked. And this was backward periods, 1 month backward and 1 month forward return worked well, 12-month backward and 6-month forward worked well, and 12-month and 1-month forward worked well. And we looked at all these across a number of variables, such as return, Sharpe ratios, standard deviations, percentage of times in which we had predictive power, worst case scenarios. And we really found two portfolios that had some real strong findings for us. One was a 1-1, meaning the 1 month backward, 1 month forward. And the other was a 12-6, a year backward and 6 months forward. And we thought we had some economic intuition for these as well, and that 1-1, perhaps news announcements and other things within the sector weren't really being impounded, and perhaps 12-6, people were under or overestimating kind of longer-term cyclical issues within these sectors. Without bogging down too much in some of the data, these are just some of the statistics for our portfolios. I think the thing to take note of is the return on the 1-1 annualized is 10.4%. It's 6.4% on the 12-6, and our volatilities are the corresponding. Our average rank is the rank of the quintile, so you would expect with no predictive power a 2.5 ranking, and we're actually ending up closer to the 2 mark. And consistency, 61% and 54% in sample. This is without knockout, the left-hand side of the screen. Without knockout out of sample, we actually even get stronger results in the 96 going forward time period, which was sort of reassuring to us that we actually achieved stronger results with a 75% consistency on the going forward 12-6 predictive power. We then extended this analysis and we said, what happens if we knock out some sectors? In other words, maybe there are some sectors where we're saying buy it, it's not really contributing anything because we don't have predictive power there. So let's go back through the old data, knock out the sectors that have less predictive power, and then essentially rerun the model. It adds to our return in sample, as you would expect. It also increases our volatility because you have fewer sectors, essentially, that you're working with. Unfortunately, out of sample, it didn't do anything for us, which makes us think that momentum is working, but that the sectors for which momentum is working are not necessarily consistent through time. If they were consistent, you would expect that this would add to your predictive power. Okay, this is just a graph of our annual returns on the annualized returns on the 12-6 strategy. And I think the important thing to take note of here is the negative periods are very minimally negative. And the positive periods are pretty good. So you don't have a tremendous amount of volatility, and your downstate scenarios aren't so bad. Those graphs were the 1-1 without the knockout, just the 1 month, and it's hard to kind of tell a lot. You just see that you certainly have more positive periods than negative, but I don't, We think that knockout at this point should not be used in combination with this unless we're able to find sort of a better way to predict knockout ability. And that's certainly something we want to do in our next steps. And again, the theory is that there just hasn't been consistency. What we think is happening is that you're seeing momentum being increasingly implemented by portfolio managers, but that they're doing it across sectors. They're rotating across sectors, and that's why you're not getting this effect. What else could we do? We want to calculate market exposure. We want to look at other time periods for the data. We'd like to look at other asset classes. We built a model that has tremendous flexibility so that we can vary percentages, we can vary time periods, we can vary knockouts, and we can just dump in data from other sectors within the UK or whatever we wanted to do, currencies. I mean, it doesn't matter what we dump in here, and see how we could extend it. We'd like to do an on-off trigger for this model as to when this model, if we could predict when it should be implemented, that would be even more powerful. And finally, we did some work on optimizing across portfolios, combining a 12-6 portfolio with a 1-1 portfolio, seeing whether it improved our return and minimized our standard deviations. Unfortunately, out of sample, it didn't show a tremendous power, but we'd like to continue down that road.
One question. How did you do the 12-6? I understand the 1-1 basically, but the 12-6 where you hold it for 6 months, and then do you rebalance after 6 months, or do you rebalance the next month?
We do a rebalancing every month, so because we assume that there are 6, for example, if you have a 6-month rebalancing, you need 6 portfolios sort of to average out because you have different starting points. If you start in January, you rebalance in July. So you start a second portfolio in February and rebalance in August, and you average that out. So it's a rolling.
That's what you should do. Okay, so it's that, and that's kind of what people do when they do momentum. I just need to know. What about the turnover in these portfolios?
We didn't track a tremendous amount. We were leery of the 1-1 results being stronger because we knew that there was going to be much more turnover in a 1-1 portfolio than in the 12-6 portfolios through time. But we didn't account for trading costs. We didn't account for the turnover. It's certainly a weakness in in the results.
Yeah, indeed, if you've got like the 1-1, it's got massive turnover compared to any of these strategies that go for a longer period. And if they're close, then you would just choose the 12-6. So ex ante, I would have chosen the 12-6, and I guess out of sample, that would have been the right move. The last thing that I want to mention is that graph was very powerful that you put up in terms of the returns through time. And you see there's very little downside to this strategy, yet when you look at the standard deviation, it looks actually pretty high. And it turns out that the reason is the standard deviation is coming from the upside, which is not a bad standard deviation. So the downside standard deviation is trivial in this particular strategy. So I think it's quite promising. That's good. Question?
Your graph ended in 98, I believe. What's kind of happened? Did you guys run it into this year?
Basically, we had data until 2000, but our model was looking forward and back 1 year.
Okay.
So because we had to look forward 1 year, we stopped at 1988 is actually the whole year of 1988, so it's really until December 98.
Okay, that's great. Thank you. Sharp minds. That's not good. You have to relog it.
You can't get these.
Okay, I think you need to relog in. Is that correct? Okay.
Yeah.
No problem.
Don't look at Becky's password.
You could probably start if you'd like. You've got the hard copy of the slides.
Well, I think that's going to happen again.
Good afternoon. My name is Ray Jacobson, and the other members of Sharp Minds Asset Management are Venkata Kodali in the back there, John Watts, Jim Sheehan, and Josh Rose. Our strategy actually picks up some of what the last team did. We actually did a predictive contrarian momentum strategy. So what they were talking about in the end of their portion with the on-off trigger, that's essentially what we examined. So our goal with the sound effects was to develop a predictive contrarian momentum strategy that will tell us, and let me just clarify that it was a market neutral. We were assuming a market neutral strategy by going long momentum and short contrarian, or vice versa, depending upon the trigger. And we also had a third alternative of investing in T-bills, depending upon the outcome, which we'll get into in a little bit. If we could go forward one slide. Anyway, our data that we used, we also used industry sector data. We used 27 various S&P industry sectors. basically top-level ones like banking and trucking, and we tried to get a good sample there. We defined momentum as simple price momentum, or a simple return momentum based on the previous month. So we picked the best 5 performing sectors at time t, and then we evaluated the returns at time t plus 1 for those sectors. And on the opposite side, we shorted contrarian portfolios, which were the worst 5 for a given month. And then we combined the portfolios. Once again, since we're taking industry sectors, which we feel are fairly well diversified, by combining these portfolios into a long and short position, we're making an assumption about market neutrality, and hence our appropriate benchmark is the T-bill rate. I'm going to then cover the model variables and talk also about logistic regression, which is what we used as our trigger. For those of you who don't know, in essence, logistic regression, all it does is it gives us a trigger. When long minus short is positive, when long momentum minus short contrarian is positive, we tell it to produce a 1. And when it's negative, we tell the column to produce a 0. And those 1s and 0s, we then regress against our variables. Logistic regression just allows us to regress against 1s and 0s. So the variables we used, we considered a variety, but the variables we wound up using were the lag change in the yield curve, more towards the medium and long-term side, the 30-year minus the 5-year, as well as the corporate credit bond spread, the BAA minus the AAA. And those were both 1-period lags. Other variables we looked at some just purely financial variables, which we were somewhat surprised didn't have significant correlation to use, including we looked at the S&P growth index and value index, the ratio among the book values. And we thought that might have some predictive power or PEs. Then we also looked at some other macro variables, which also failed to pass muster. I'm going to hand it over to John, who's going to talk about our model and trading strategies some more.
Thanks, Ray. You see before you the regression statistics from the model. The bottom line is that the model p-value ended up being a little more than 0.02. The explanation of deviance that you see is unique to logistic regression. You can think of that in terms of an R-square. So for a predictive model, this has a low R-square that we're used to, around 2.8. The formulas you see below are just the formulas that a logistic regression gives you to determine the actual value of the dependent variable. Once again, that was the LM minus SC is our dependent variable, the long momentum minus short contrarian strategy. Next slide. The regression's predictive power is explained on this slide. The example before you shows how we came up with our column of 1s and 0s. The bottom line is anytime the LM minus SC strategy returned a positive return, we would assign a 1 to it. The logistic regression would then go ahead and predict what that variable would have been given the coefficients. And you can see on the first row, it would have predicted 0.72877. We would assign a 1 to that, and then it predicted it correctly, so that would be a yes. You can go all the way down to the bottom and see that our model for the entire time horizon from 1980 to 2000 predicted 131 out of 247 time periods accurately, which is really just a little better than 50%. It ended up being 53.04% predictive. Next slide. We then took our strategy and executed it by using the trigger that Ray alluded to. Anytime that our raw predicted value was greater than 0.6, we took a position in the long momentum short contrarian strategy. Anytime it was below 0.4, we took a position in the long contrarian short momentum strategy. And anytime it was in between, that 20% in between, we said, well, we really don't have the predictive power to decide which way to go. It's kind of back and forth, so we decided to go in T-bills and take sort of the risk-free approach there. You can see an example below as to how that would work out, telling you which position we chose depending upon the predicted values. Next slide. So your question is, how did it perform? The bottom line, it's the right slide, is that you can see the benchmark of the S&P, which really isn't a benchmark, but just for reference, performed during our entire horizon from 80 to 2000, around 18% annualized. T-bills returned around 6.65%, and our strategy returned 10.34% annualized over the entire time period. Next slide. This graph just is another way to depict the cumulative returns of just a buck invested in our strategy versus the T-bills. The top line is the strategy. So that just gives you an idea of the difference. Next slide. Out of sample, just like the previous group, our strategy did pretty well because once again it does have a momentum basis. Our sample ran from 80 to 97. That's how we actually did the regression. And then we took the 3 years from 97 to 2000 as an out of sample. We tested it out of sample. You can see that the average annual return in sample was 9.64% with our strategy versus a T-bill of 7. And then out of sample was actually 13.65% versus a T-bill of 5.06. So it actually performed a little better out of sample versus in sample.
So just some concluding remarks. Before I get into them, just wanted to remind you of a slide we saw where we plotted the T-bills versus our optimal strategy. Again, most of the volatility tended to be on the upside. We had some last-minute technical difficulties with volatility, but the overall, with some of the charts, but the overall volatility was around 8% off of a 10.3% return. So our strategy did generate positive returns in excess of T-bills. The percentage of the time that we accurately predicted the returns was somewhat questionable, and once you incorporate transaction costs, we're not necessarily sure how robust this model is, considering the much lower volatility of T-bills. We were a bit surprised that some of the financial variables didn't have as much predictive power. Of course, there are other variables that, with further time we could look into, as well as other variations on contrarian momentum that we could look into, including different time frames, more than a month. And just a note, credit spreads as well as the yield spreads did work well. And there is some economic justification given that as the spreads widen, people are flocking more into quality, and that'll definitely have an impact most likely on contrarian versus momentum strategies. And finally, we did not really consider track the turnover as you had asked the last group.
So did you look at the lag momentum contrarian spread as a variable in the logistic regression?
The actual spread between the strategies themselves, no, we did not consider that as a variable in logistic regression.
So its own track record could be important.
It could.
In determining whether it's going to win.
And that would be easy to throw into the regression model, certainly.
Everybody sees what's going on here. Often I like thinking of this in terms of value and growth, like when will value win, when will growth win? So you just go back in the data, and every month that value outperformed growth, you put a 1 in a column. And every month that growth outperformed value, you put a 0 in. So you get a series of zeros and ones. And then you just try to predict that with lag variables. Okay, and that's where logistic comes in. And logistics fitted value is between 0 and 1. And you would interpret it in my regression as the probability that value would outperform growth. And you get a number. And what you've done here with these trigger points is exactly what you should do. So if it's around 50%, then there's no sense taking a bet. Let's just drop it into cash. But if you get 60 or 70 or 80%, you're more confident that value is going to outperform growth. And you can execute a trading strategy based upon these trigger points. So it's a very useful tool.
If you're either essentially long momentum and short contrarian or vice versa, and you're comparing against a market neutral benchmark, wouldn't you tend to think that you would typically either have the beta being high from the long momentum, so that you would have a beta greater than the market significantly, or that you would have a beta significantly less than the market? And so that, yeah, it would average out over the whole time, but in each individual period.
Right, that does make sense. You're saying because you're looking at betas in a very short time frame. However, it's probably hard to accurately measure betas over a very short time frame. And over the long term, betas of diversified, even though they are sector indices, trend towards 1, I think is a fair assumption that we made. I just want to add one more addendum that if you just did not include the switching strategy and just went long momentum minus short contrarian, it's net average annual return of 4% with a volatility of around 20%. So it's definitely an improvement from the naive approach.
Okay, we have to go to the next one. Thank you. Okay, last is Looney Tunes.
Okay, hi, we're Looney Tune Asset Management. This is our team, Juan, Kenny, Russell, and myself, Peter. What we did was, the objective of our assignment was actually to apply the cross-sectional stock selection model that we learned in class to the South African Stock Exchange. What we hoped to do was identify the intricacies of building such a model and actually running it with the order of about 100 securities, which is quite large. If we look at the model design, what we needed to do was code it up in VBA, which is attached to Excel. We couldn't then run it, keep the data in Excel because there's too much data to sit in Excel. So what we did was we put it into an Access database and then leveraged the Excel solver and correlation tools to actually do some of the calculations. What the model is it's very scalable. We can use it with a number of attributes and a number of stocks. So we could move this to use S&P 500 if we wanted to. Just to go through the model flow, how the program actually works is, first of all, we go through each of the firms and we run a time series regression in order to determine the firm-specific coefficients, which are then stored in the database. We then retrieve the attributes for each of the 100 firms and multiply that by the coefficients at each time period. And then perform the cross-sectional analysis, and then store those coefficients back in the database. We then, having generated forecasts from those coefficients, we generate a covariance-variance matrix, also by looking at the correlation between each of the stocks. So we get about 2,500 correlations between each stock, and then we build the matrix, put in the expected returns, and we then get a weighting for our portfolio, assuming that we don't do any shorting, just to make the solving a little bit easier, because solver's now solving with matrix 100 by 100. Just to give you an idea of the database layout to make this work. Funny how this pen works. Okay, we store securities. We have our 100 securities in the securities table. For a model, we put in a list of the attributes that we're going to use. We can use as many as we want, providing we've got the data for it. And we can then build a number of models to run through. We store the returns in the returns table, which is about 10,000, has about 10,000 records, and the attributes matching those in the attribute table. Once running through the model, we store the coefficients, the time series coefficients in the coefficients table. And we also store the standard error and the t-statistic as well, so we can see how significant each of the coefficients is. The covariances that we generate, the 1,500 covariances from our regressions between securities are stored here. Then we go along and we run the cross-sectional model, and we store the intercept in this table as well as the R-squared and F value for the model, and the t-statistics for each of the cross-sectional coefficients. Having then built our covariance variance matrix, we will then optimize our portfolio to match the variance of our benchmark, and we will store our portfolio weights in there. We run through this for the in-sample test, and we can then match our performance. Some of the problems that we identified in building something like this was, first of all, our base data was rather incomplete, and it adds a lot of complexity in terms of the modeling. You have to put a lot of error checking in to catch problems that pop up that you didn't expect to be there. We did get some low explanatory power of the variables that we used, also largely due to the fact that we didn't have very clean data. And then obviously with in excess of 100 securities, we had long processing times. Results, just to test our model, we used one attribute, book to market, and we did a 2-year in-sample test, which we ran through. Unfortunately, our R-squared on the model was 2%, so it doesn't have huge predictive power. We did, though, store the portfolio and look at how it performed over time, and we benchmarked that against the JSE All-Share Index, which is the South African stock market index. And we seem to, in our in-sample test, we seem to outperform the index slightly with the same volatility as the index. Proposed future improvements are using GODS to actually, instead of just using an average variance, we can use GODS to forecast a variance in building our covariance variance matrix. Extend the infrastructure we have in place, because it's very easy now to extend it to a sorting screening model, and then add further attributes into our database and clean the data up further so we can try and get better predictive models.
Okay, so the first question I've got is whether I can put that software up in my secure credit card facility. When you said problems with the data, do you mean that for some of the securities you've got missing data, so it's not all like there's holes in the data or bad data?
I would say it's holes in the data, and it's when you're doing a time series regression, that doesn't really make it it doesn't cause a problem. Because if you've got a hole, you just discount that data point. But when you're doing a cross-sectional regression through time, as soon as you get to a hole for one of the securities, that security is no longer in your regression. And then when you want to forecast it on using a lagged attribute, say a one month lagged attribute, if that attribute is not there, it can't forecast it. So then that's not in your portfolio. So you start losing securities out of your portfolio where you shouldn't be. So you've got to actually run through that and pick that up and try and fill those gaps as best as possible.
Yeah, and actually, for the people that study cross-sectional regressions, and it's called panel econometrics. This is the problem of unbalanced panels. And there is a literature actually on it, which I could maybe show you. As to how to get around some of these problems, how to fill in, basically, in a way that's not looking forward into the future. Any questions? Okay, it's an amazing piece of software. Thank you. Yes. Thanks. Okay, well, we are at the end of the course, and let me make some general remarks about the presentation. I'm going to scoop my laser pointer. The thing that always amazes me is what can be done in a short period of time. And though maybe it didn't seem like a short period of time to a lot of you working all night, because I know what the story is, getting emails that are like 3 o'clock in the morning date on them. So I know it's a lot of work, but and this course is a lot of work, as you found out. Now, hopefully, it met expectations in terms of the amount of work that was necessary for this course, because I know to do all the assignments is a huge amount of time. And I guess assignment number 5 I will post when I go back up to my office about 1 or 1:15. Make sure when you load it in, you hit reload to make sure you get the fresh version. It says very clearly it's due Friday, 9 p.m. Email me a file. Just let me emphasize a few things that are in the document. 2 pages, no smaller than 10 point, okay? And reasonable margins, okay? So I should have said 8.5 by 11, right? Somebody could set the margins out to 20 by 20. But reasonable margins and no fancy embedded graphics, no embedded macros. There's no data work necessary for this, okay? It looks very similar, and indeed some of the questions extremely similar to what you've already seen for the last year's assignment number 5. It shouldn't take a lot of time. You should, if something's not clear, then just make an assumption, okay? And it's true that maybe some of the questions might be a little ambiguous. That's fine. You know, maybe it's supposed to be like that. Make an assumption, no data work, and you've got to scan your file before you send it to me. This is done by email. Don't post on the iDrive, okay? It's done by email, and this is an assignment for you to do, not to share with other people. So I don't want people talking about the details of these questions. If you've sat here for the 11 lectures that I was talking, this should be straightforward. Some people can do this assignment in 1 hour. Indeed, it'll be interesting to see the first one that pops into my reader. That's how I usually judge it. So he just sits down, writes it out, emails it, it's gone. So, so that's, you know, there's 5 questions. There's also evaluation question at the end, but fairly straightforward. But I guess, you know, the idea of this course is to get you involved in doing some research, and we did see this in assignment number 1. And as I said, for the limited amount of time that you've got to put this stuff together, can you imagine if you had a research staff and you had, you know, full time to devote to this? So the bottom line in this course, and you know, it's called Global Asset Allocation and Stock Selection. The bottom line in this course is that with a fairly rudimentary set of tools, okay, and even running in Excel, that there's a lot that potentially can be made in these markets. Okay? And it doesn't mean that you have to be playing small cap stocks and overseas market, even within the US. So in terms of the standard metrics for doing benchmark or standard risk adjustments, there's a lot of possibilities here in terms of using research in a way to reap some excess return. Okay? And one of the things that people think, well, I just can't do research because, you know, I'm competing against these people with PhDs in physics. Those people with PhDs in physics are likely working on derivatives pricing, so option pricing, and that's probably not what you want to do. Okay, but the actual tools that you need to do a lot of this work are as simple as regression. Okay? Indeed, I've taken a look at some regression predictions versus more complicated models. So very complicated dynamic coefficient models, neural networks, genetic algorithms, wavelets, you name it. And the regression is simple, it's easy to run, but it imposes a discipline of, if you look at a coefficient that comes in, it's got to be intuitive. It's got to make sense. And if it comes in with a t-ratio of 2.1, and the variable itself doesn't necessarily make any sense, then you're probably going to throw it out, and that's going to be the right move. Okay, so you always have to apply what you think is reasonable. So half of this is maybe mechanical in terms of quantitative tools. But the other half, and maybe more than half, is your ability to use intuition and judgment in kind of selecting the model form. And even after you've selected the model form, your ability to say sometimes, I'm just not going to go with the model. I'm going to have to override. Okay, so remember, all of these models are simply methodologies to simplify a very complex reality. Okay, all of these models are wrong. Didn't see any 100% R-squares, and even if we did, going out a sample, it's unlikely we're going to see 100% R-squared. The key in what we're doing is to use our judgment, to use the quantitative tools in a way that puts us in the right tail of the distribution. So think of all the people in the market and think of the distribution of skill. And skill, for me, is defined as this combination of quantitative ability and using judgment. We just want to be in the right tail. Actually, we would like to be in the extreme right tail. Okay? But if we're in the right tail, then we're going to perform very well. Okay, and this is, I guess, in terms of the practice of management, obviously what we want to do. If you're successful, then it's good for the school. It's good for me, too, I think. Okay? So, so that's it. And I guess right at the end, what I'd like to do, and I'm not sure people are around, I wanted to introduce all the people that worked on the webcast. And you, I guess, don't see all of these people, but there are a huge number of people. Actually, I count 11 people at Fuqua that were actually involved in doing this webcast. So all behind the scenes sort of stuff. You've seen some of the production team, like Mike Millard over here. And Tim Searles is at the back. I think he's going to walk in. He's a producer. And I guess, Matthew, you're going to come in also? Put it on autopilot? Yeah, okay. The producer is right here, Tim Searles. And you've received emails from him. And he did a tremendous amount of work for all of us. Okay. Yeah. So we had, so this is our production crew, and there's a lot of other people. Anybody outside or?
I didn't say anybody. Okay,
well it's at 12:30. Well, what can you do? Let me just mention all of the people. The engineer, the chief engineer, was Corwin Armstrong, and he was the person that actually got this to come together in terms of the feeds going to Digital Island, all of the negotiation. Just the hours that were put in for this, just unbelievable, including this conference call that started one day with 8 people on the conference call, started at 3 in the afternoon and ended at midnight. Connecting New York and California and us trying to straighten all of this stuff out. I guess the other people that were working on this include Brian Eder, who is in charge of all of the user interface, all of the coding that goes into this in terms of the HTML and all of the overlays on top of that. And user support, we had, I guess, Susan Simcoe. If you looked at some of this stuff, like the frequently asked questions, there's a whole other class this size, right? That's interacting with our IT people. So Susan Simcoe, Marvin Thiel, and also from IT infrastructure, Steve Galla, Matt Miller, and Kevin Smith. So I think I've mentioned everybody The last person, of course, is the person who's the dean at Fuqua in charge of IT, Nevin Fouts. And he was, when I came into his office and said, I want to do this because I really think that it could enhance the experience for you people and maybe provide something for the future for you people. He was 100% for this, and we invested a lot of money in actually doing this, to refurbishing this classroom, to getting fiber, which wasn't available here beforehand, and a lot of scrambling was going on before this course actually began. So it was a big effort, and I hope that, actually, in a way, you feel like apologizing a bit because of the intrusion of all the camera crews coming in. The last one was particularly disruptive, but that's the cost of being first, and we were the first to do this. And I hope that you've got the list of the webcast students up there, that these might be people that you can keep track of in the future. I know that some of you have contacted them already in terms of job opportunities, which is fine. So so that's it. I'll keep this on archive for a while, and actually, hopefully, we'll keep it on archive to the end of December, and then reload up a new set beginning in January. So thanks for putting up with this. I always enjoy this course because, especially, this is the lecture that for me is my favorite. Not because I'm not performing, but because I see what sort of ideas that you've got throughout the course, and that's to me real exciting to see impact almost immediately, and extrapolate that forward as to what could happen with enough time. It's also the lecture that I'm the most nervous. Like when I'm talking, I guess I'm not that nervous, but when you're up there, if there's a technical glitch or something like that, it makes me quite nervous. But that's it. So thanks. And the last thing we have to do is course evaluation. I will hand that out, and we could probably end the webcast now. Okay, so now I can swear.